just do that. And then Phil, you want me to just kick it off?
Yeah, whatever you want to do. That's fine.
All right. So we hit, oh, oh, there it is. Okay. So I just have my intro for Phil here. So Phil has 30 years in sales and marketing. He also has 30 years in real estate as an agent at one time, as a property manager, and also as an investor. 25 years in the mortgage business and over 2,000 closed deals. So we got experience coming from all different angles here. He's a licensed mortgage loan officer in multiple states and a licensed real estate instructor. He has instructed thousands of agents in the subject of real estate and mortgages, and he has invested in properties as flips and currently owns multiple rental properties. So Phil, we're honored to have you here. I'm going to let you take it away. It's a great intro.
It's my pleasure to be here. And isn't technology great? You guys are in your PJs and I'm here in my shorts and we're on a business call.
Yep.
I love it. I absolutely love it. Mike and I were talking about that, how wonderful it is to have a little technology, right?
Yeah, we had the same thoughts on dressing today because I also have shorts on and we picked almost the same shirt. So it's
we collaborated on that. So Mike, thanks for the intro. And yes, I've been around the mortgage and real estate business for a while, since 1996. And I do realize that was before some of you guys were even born, right? Some of you young people out there probably born in the late 90s, early 2000s. But yeah, I've been around the block a couple of times. I remember doing business without cell phones and actually using paper maps to find a location. I know it sounds weird, and actually handwriting mortgage applications. I was in the mortgage business during the real estate crash between 2006 and 2010, and I survived. It was difficult. It really was difficult, but I made it through. As the saying goes, what doesn't kill you will make you stronger, right? So the aftermath of the crash was that sellers couldn't give away houses. I know that sounds strange, doesn't it? So keep in mind that the real estate market is cyclical. Sometimes it is a seller's market where there's high demand and low supply, kind of like now. And sometimes for various reasons, like the mortgage crash that we had, there is more supply and less demand, so it becomes a buyer's market. So the point is, always be prepared for anything. And of course, continue to pursue your seller leads, but don't forget the buyers as well, as I believe they will become a more important piece of the puzzle. So as Mike said, I've been around business. I've done a lot of things, flips, real estate, rental properties, property management. And I'm going to share with you some of my experiences and how we can help you. We're going to do a Q&A at the end of the class. So I think if you have any questions, please write it down. So I don't have a crystal ball to predict the future, but I will be presenting some good information that will help you prepare for the future. I like inspirational quotes. I read a lot of them. And here is one from Benjamin Franklin. By failing to prepare, you are preparing to fail.
Yeah.
Okay.
That one.
It's right on. We have to prepare. We don't know what's going to happen. We have to prepare for all the eventualities and then look at what the probabilities are. What's going to happen? More likely to this or more likely to do that, right? So again, I want to thank you, Mike, and Glenn, of course. I've known Glenn for over 10 years. Sean, Monica, you guys have been fantastic. And I know that your goal is to help the agents that you work with succeed. And I certainly appreciate the invite. All right. And my goal is to help you succeed in whatever way I can. So here we are. I'm going to address a few questions that you and your clients may have to navigate and succeed in this changing, crazy real estate market, right? Question number one, should a client even be looking for a home in today's market? And if so, why should people still want to purchase a home? Question two, homes are not selling as fast as they once were, so clients don't want to lose money in the long run. So before I even address the question, you may ask yourself, why is this even important to you? It is because you are a professional and your job is to guide the buyer or seller through this challenging process of buying or selling. You want to become their trusted advisor. You want to be their agent for life. If they think of real estate, you want them to think of you. And that only happens if you are a trusted professional. Now I'm going to answer both of these questions, at least discuss them. And then we'll get to the third question about the direction of real estate. So in my opinion, clients should absolutely be looking to buy now because of long-term wealth and housing payment security, and also some emotional reasons to buy. These reasons should be in your repertoire when speaking to clients. You should be letting your clients know these facts and highlighting the emotional reasons as well as the financial. So here are some emotional reasons that I would definitely discuss with clients. Some of them are safety, some of them are security, fun, lifestyle. So a fixed mortgage payment provides long-term housing payment stability and security. It's a fixed monthly payment. It's not going to go up like rent. Anybody who rents, you realize that the cost of rents have been going through the roof, right? How about this? Emotional reason, build memories. This is a huge factor, a huge factor. You're gonna have barbecues, you're gonna have birthday parties. It's not just a house, it's a place to build memories, right? Another emotional reason, security for their children. If they have a family, they want security. They want a safe neighborhood for their kids to grow up and have great memories. And lifestyle, that's another emotional reason. It's about having fun. You know, you have a backyard, you can have pool parties, you can have barbecues, you can have all kinds of things compared to an apartment. Can't really do that in an apartment, right? So there's a lot of emotional reasons. And again, you should highlight that when talking to clients, especially buyers. So here's some financial reasons, okay? The media, and I sent you guys some charts. I don't know, Mike, if you haven't sent them out, maybe you will at some point. The median price of a house in the US in 1972, about 50 years ago, was $26,000. That's the median. Half sold for more, half sold for less, right? I know with me, my parents bought their house in Elmont, some of you guys may know where that is, in 1969 for $29,000. So in the 70s, 72, 50 years ago, the median price was $26,000. In 2022, 50 years later, and again, this is across the United States, in 2022, the median price is $373,000. That's a huge increase of almost $250,000. So long-term appreciation is about 26% per year. Yes, I was a little surprised when I ran those numbers, but those numbers come from the National Association of Realtors and Case Shiller. Case Shiller does a lot of charts like this. So, however, when adjusted for inflation, the appreciation rate is really about 2% per year. So if $1 today was worth what it was 50 years ago, if $1 today was worth what it was 50 years ago, then real estate actually appreciates 2% per year, adjusted for inflation. So this tells us two things. Owning a home protects you from inflation. Your net worth is increasing 2% per year above the cost of inflation. And number two, it tells us that owning a home creates great wealth in the long run. Speaking of inflation, what is it? Well, let me talk about that for a second. It's the rise in the cost of goods and services from one time period to another, usually over a year. So just to give you an idea of the effect of inflation, $1 in 1972 has the buying power of about $20 today. So buying something in 1970 for $1 would cost you about $20 today. That's from the Bureau of Labor Statistics, the US government. You can see these charts, and again, I sent them to you guys, so you can see them if you don't have them now. There are lots of reasons for inflation, but for the most significant reasons, because the government keeps printing money, creating a huge supply of money, dollars, which devalues the currency. Without getting political, be careful who you vote for, because if a politician promises you to give you free stuff, usually means they're going to be printing dollars to get there, and inflation is going to keep going up and up, and you're going to need to make more money to afford that same product next year. That's why inflation is called the silent tax, because it reduces our real income, and it means we have to make more money just to keep the same standard of living. It's not pretty. So what does the Federal Reserve, the Fed, do when inflation is high? And you've probably heard about the Fed recently. One of their stated objectives is to keep inflation from rising above 2%. So what they do, they raise interest rates to slow down the demand and spending, which reduces prices and slows down the economy. Think of increasing interest rates as hitting the brake on the engine of the US economy, and reducing interest rates as stepping on the gas pedal. Right now, they're stepping on the brake. They're trying to slow it down to keep inflation under control. So here's another reason why owning a home is vital. Another great stat to talk to your buyers about. When going to retire, the average American homeowner has over 90 times more wealth, net worth, than the non-homeowner. 39 times, okay? For the net worth of the average homeowner today who's retiring, their net worth is about 254K compared to 6,200 for the non-homeowner. This right there is huge and should be discussed with every buyer who says he doesn't want to buy now because prices are high. In the long run, it's only going to go higher. Okay, that's a great stat to share with people. Having said that, we do have to understand how difficult it is for buyers today, right? How bad is it for clients who are trying to buy a house today? According to a recent Zillow survey, more than 50% of all home buyers found the process so stressful that it brought them to tears, literally to tears at least once. Roughly 61% of Gen Z and millennial buyers cried during their home search. Yes, it's that challenging. It's a challenging time for home buyers right now due to limited supply, right? Especially in the metro area. During December of 2021, inventory of existing homes hit a record low. And as we know, in the metro area, there's not much new construction going on. So with limited supply, prices will probably continue to rise for the near future. The one wild card in discussing supply and demand is interest rates, which leads to the last question I will discuss. Question 3, what do we see with interest rates going forward, and how does that affect demand for homes and, of course, prices? I'm going to give you a crash course in how mortgages work and how inflation affects interest rates and mortgage rates, and talk about the direction of interest rates. So why are interest rates going higher? We talked about inflation. It means the cost of products and services have risen compared to last year. What does that have to do with mortgage rates, you may ask? A mortgage is a fixed income security that pays investors a fixed rate of return, just like a CD pays you at your local bank. Individual mortgage loans that we do and close as a bank for your clients buying homes are then packaged together or pooled together and sold to investors as mortgage-backed securities, or MBS. Those investors who invest in mortgage-backed securities get paid a certain return based on the interest rate of the loans in that pool. Easy to understand. When inflation is high, that means the value of those mortgage-backed securities is worth less. Think about it from your point of view again. If you put money into a savings account and the bank is giving you 1% per year, which is the return on your money, but inflation is at 8.5% per year, as it is now, what is happening to the real value of your savings account? You're actually losing 7.5% per year in value of your savings. Your buying power is decreased by 7.5%. Think of mortgage-backed securities or interest rates as a savings account for investors. When inflation is high, investors are demanding a higher rate of return or a higher interest rate on the underlying mortgages to make up for the loss in buying power due to inflation. And that is why mortgage rates are going up. Hopefully that gives you some insight. At the beginning of the year, mortgage rates were in the low 3s, and now they're in the low 5s, maybe the mid 5s. What does that do to a buyer's mortgage qualification? Well, a 1% increase in mortgage interest rate, reduces a buyer's approval, their buying power, by 13%. 1% increase in mortgage rate reduces their buying power by 13%, assuming everything is the same, financials, credit, debt, etc. So an increase in rates of 2.25%, as they have now since the beginning of the year, that we've already seen, reduces a buyer's mortgage approval by about 31% since the beginning of the year. So if a client was approved for a $400K mortgage last December, now they can only afford a mortgage of $276K. If they were approved for an $800K mortgage before, now that number is $552. That's a big change that is affecting how much a buyer can get a loan for. So here's a word of advice. Before you spend another minute working with buyers who have been pre-qualified or pre-approved, get the mortgage approval updated ASAP. Even if it was from a month ago, their qualification has changed. Just as a FYI, if you ask the loan officer you're working with what makes mortgage rates move, and he says the Federal Reserve, then it's time to find a more informed loan officer. As I mentioned, mortgage interest rates are actually based on mortgage-backed securities. And while they have some correlation, meaning they move in a related fashion, they don't move one-to-one, right? So that's why even though the Federal Reserve, only raised rates twice since the beginning of the year, one time by 0.25% and the other time by 0.5% in May, mortgage rates have gone up over 2.25%. As I explained before, mortgage-backed securities are based on investors' desired return on their investments. And as we can see, investors who buy these mortgage-backed securities, they understand what inflation does to their investments, and they want to get a higher compensation or return for those investments. So we get higher mortgage rates. So right now, inflation is running around 8.5%. And I don't have my crystal ball with me. I wish I did. But I do believe mortgage rates will be around 6% or higher by the end of the year, or possibly even sooner. Matter of fact, the last couple of days, if you've been listening to the markets at all, the news, inflation, they just put out the inflation numbers on Friday, I believe it was, and inflation, the PCI, is 8.5% greater than last year. And so the markets have reacted, the mortgage markets, the stock market have reacted viciously since Friday and today. Went up a lot, mortgage rates today and even Friday. So what does that mean to you? Tell your sellers to sell now. If they want to sell, do it now, and to have reasonable expectations of the selling price. As we saw in our example, a borrower's buying power and their affordability has already decreased by 31% since the beginning of the year, and probably will decrease some more, which is going to take some buyers out of the market, right? And which means that there will be less people competing for the same properties, less demand. At some point soon, it's probably going to force sellers to take less for their properties, thereby softening the real estate market. You may be seeing that with appraisals right now. While you may still be experiencing a panic from buyers to get into a house right now, the market should become more equal by the end of the year. At least that is the general opinion amongst professionals in the business. As a side note, I do think that real estate investors, especially ones with cash, will become bigger buyers since they will see a good return for their real estate dollars. But they don't worry as much because they don't worry as much about interest rates because they're probably using cash. But of course, these same investors are probably savvy and won't pay asking price, or certainly won't go above asking price. So if you're listing a property, I strongly suggest, don't overprice it. I follow the real estate markets closely, and I already see prices being reduced, or in real estate lingo, repriced, or now price to sell. As you know what that means. That means they lowered the price. As you probably know, you get the most interest in a property the first few weeks it's on the market. So price it well, or it will be sitting, and then you'll have to reduce it. And obviously your seller is not going to be happy at that point, since their expectation is the price that you originally told them. This is why educating your client about the state of the market when you go on the listing presentation is key. Use some of the info I just gave you as ammunition about buyers being able to afford less house. One last point on interest rates. Interest rates for an average buyer with a standalone are somewhere between the low to mid fives, which are the highest they've been since April of 2010. And some agents may tend to get nervous and wonder if buyers will still buy homes. And the answer is yes. Buyers may be a little bit more cautious, a little bit more nervous, but they will still buy for the reasons we discussed before, which hopefully you're bringing to their attention, right? Most of you may not remember this, but back in 1982, many years ago, probably before most of you guys were born, mortgage interest rates were in the 16 to 18% range. And yes, people were still buying homes. Obviously, there will be a price adjustment. So I expect that to happen depending on how high mortgage rates go. Remember, it's about affordability, not interest rates, right? If a client starts talking about interest rates and the fact that they're higher, move that conversation over to the monthly payment. This is the most important number for someone buying a house. What is their monthly payment compared to what they are paying for rent? And discuss the key benefits of owning a house, as we talked about before, the emotional ones, as well as the long-term financial benefits. And I didn't even touch upon the income tax advantages of owning a house, the tax deductions that an owner gets. We can discuss that on another call. Also, we can discuss how owning rental real estate is one of the best ways to increase your net worth while keeping pace with inflation, right? So in today's crazy mortgage market and real estate market, experience matters. I have been loan officer for over 25 years, closed over 2,000 deals. Experience matters, and I would be happy to share that experience with you and your clients. Obviously, the goal would be discussing their mortgage options, but also here's an example of where experience matters. Knowing when to lock a mortgage rate is very important in today's volatile interest rate environment. We as a company recently took one of my loans, took a loan in on a Friday and got an approval on a Monday. So we then locked in the interest rate. In today's mortgage market, not locking the loan in can result in a loan going from being approved to not being approved in a matter of a week or two, right? So the last question I was asked to address is, how do we get deals done and how do we bulletproof our deals? I believe, Sean, that was your question. So as an agent, of course, you want your clients to have as many options as possible when it comes to getting mortgage financing, since not all clients are the same, right? As you know, not every client fits into the standard W-2 income, great credit, great down payment box. It just doesn't work that way. As a company, we have a wide variety of mortgage programs, and I believe I emailed that to you guys as well. So take a look at that, please. We have renovation loans, which if you haven't done one, is a great product to have because people can buy a house as is, and we will give them money to buy it and renovate it all in one loan. Okay. We have stated income loans. We have bank statement loans. I recently did a loan with a self-employed client who did not show a lot of money on their tax returns, but they showed a lot of cash flow in and out of their business. Okay. And we closed that deal. And I'm doing quite a few of those loans right now. We also have investor cash flow loans for your self-employed borrowers. And of course, we have the more typical mortgage loans like conventional for single family, multifamily, condos, co-ops, FHA, VA, and we also do commercial loans as well. We basically have loans for almost every client and scenario. Of course, there's always some qualifications like credit score and assets needed. So let me finish with this. How do we bulletproof our loans? How do we bulletproof our deals? So JetDirect recently launched what we call a Mach 1 mortgage commitment. It's a pre-approval commitment that certain experienced loan officers like myself can put forth. We call this, again, a Mach 1 mortgage commitment. I think, again, there's a handout there as well. And it is an actual mortgage commitment for that property. Imagine having your buyer make an offer with a mortgage commitment instead of a pre-approval. This will help your buyer's offer get their offer accepted and give you more confidence if it is your listing. If this is if it is one of your listings, how confident would you be knowing that the file has already been underwritten? So your question may be, well, how do you do this? Well, giving a mortgage commitment before signing a contract, that's really how do we do that? Well, we run the mortgage file. This is why it's through experienced loan officers only. We run the file through Fannie Mae and Freddie Mac underwriting engine. It's called desktop underwriting, DU. Once we get an approval, we then run the property through Fannie Mae's AVM, their automated valuation model. So basically, we know if with appraisal, we can get an appraisal waiver. Okay, that means we will have a commitment and we could possibly also have an appraisal waiver because the AVM runs through it. Okay, so think about how strong that is for you and presenting with your buyers, and also if you have one of these buyers with your property. Okay, so I like to tell all my referral partners that whenever we work on a deal together, we are partners. Your deal and your paycheck is the same as my paycheck. So I will not waste your time. I will not BS you. I will treat you as I want to be treated, with honesty and respect. And I will use all the resources that I have available and do all we can to get to the finish line, right? That's the most important thing. We have an almost 93% close ratio on all my loan applications. If you compare this with other lenders, it is way above average because honestly, I spend a lot of time looking at the file, making sure the file will work, right? I look forward to working with you on any deal you have, even if it's not my deal. I'm here to help you guys, honestly. Again, even if it's not my deal and you have a question about something, financing, I've had real estate agents call me about, hey, I've got this deal, they got a commitment, and now they're backing out of it. What happens? And I'd be happy to explain it to you. Again, my goal is to help you whatever way I can. Okay, so that's basically it for me. I don't know how much time we took, but any questions? I'm opening up to questions.
Oh, hi. I came in a bit late. Do you have any videos or other informative sessions where I could get info on you?
On me personally, well, you can
Like
go.
what you do?
Yeah,
Like,
yeah. I have a if you go on, I don't know if you guys have this, and everybody should have it. One of the few things that I like about Zillow, not that many things, but one of the things is that they actually allow you to create a free Zillow review page. And I did that, and I have like 105 reviews. So if you go on Zillow and just look me up as a lender, you will see my reviews and a little background on me. Certainly, if you like, I can send you an email with some my qualifications that you can forward over to any kind of clients. I can also send you information on the type of mortgage programs that we have. I did send a couple of charts and some mortgage programs, so you can see that as well. But you can always call me. I'm always available via cell phone, except when I'm sleeping. That's about it.
awesome.
Phil, do you want to put your cell and email in the chat, or I can do that actually if you're fielding calls. If everybody
Yeah.
opens the chat, and while you were speaking, Phil, I was posting on a screen share each of the slides. We can email those around to anybody else whose email we don't have, but those are on there too. So I'm going to put Phil's info in the chat.
Phil,
That's perfect.
Thank you, Mike.
Phil, do you think rates are gonna go up this week with the like when they get raised on like later this week?
Yes. Well, they've already gone up. The inflation numbers came out on Friday, and they were higher than expected, 8.5%. They were expecting less. Last month, they were at 8.3. So everybody's looking for what they call peak inflation, meaning that inflation is peaked out and it's going to start to subside. If that happens, when that happens, then they believe that the Fed will ease off on raising rates. But unfortunately, that did not happen. The opposite happened. The PCE, as it's called, actually went up higher than expected. So what that did to the mortgage market was it literally between Friday and today, it went up like average mortgage went up between 1/4 to 3/8% in the rate. That's high. That's a lot. That's huge movement. Huge movement. So that I think already is priced in what the Fed is going to do. The Fed is probably going to raise rates 0.5% again. They've already kind of telegraphed that a little bit.
So do you think if they go up sometimes, like last time I feel like rates bumped up, then they came like down a little bit recently and then they go up again. So if you had someone like this week, would you lock them now or would you like wait a couple weeks because it might go back down to like low 5?
That's a good question. I actually had that conversation with a client today. We got their approval on Friday, late Friday. So today I was waiting to see what happened with the market, and it went up again today. I thought it was going to bounce down because it went up high on Friday. I thought it was going to bounce down. It didn't. So I told the client, I said, look, it's your call, but I think they're going to bounce down a little bit. I don't think it's going to be a lot. I think only because these inflation numbers are fresh on everyone's mind. They just know that rates are going to continue to go up. You know what I mean? And I don't think there's any doubt that they're probably within the next 3 to 4 months, by the end of the year, we're going to be at 6. I'm pretty sure.
Yeah. So does your bank JetDirect do float down?
Yes. So as long as I believe it's got to be more than 1/4% float down. Yeah. So that we can do. Yeah. And that does work.
10-seconder on the float down for everybody.
Float down is when we've locked in a rate, but if rates go down by more than 1/4%, we can then revisit it. And as long as it makes sense, obviously, then we can float it down by. It's got to be more than 1/4 of 1% that it has decreased, right? So that we can offer the client. Yes, absolutely. And that's a good tool. That's a good tool.
you lock in the lower rate, but then you can also float it down.
Yes, we lock in wherever the client wants to lock in it, right? Because I don't tell the client where to lock in. That was not my position to do that. I inform them where rates are that day, right? Because what we do is we take the loan in as soon as we get it approved, usually within a day or two, then we can lock it, right? Depending on when they're going to close, right? Because if I got one client they can't close for 3 months because their seller is not going to close, right? So in that case, it doesn't make sense to lock, right? Because you can't, you could get a 90-day lock, but you know what happens? A lock, the least expensive lock is for 15 days, then 30 days, then 45, then 60, then 90. The longer the lock period, the longer the bank has to keep that money put aside for you, the more expensive it is, meaning the higher the interest rate is. So if you really believe rates are going to go through the roof, then yeah, you may want to do a 90-day lock. But most people don't do that. They'll say, okay, well, I'm going to wait until I'm like 30 days out and then I'm going to lock, right? And normally that's a good strategy. But in today's market, it's so volatile, it's one of those things you're kind of gambling a little bit. So I would tell people lock in for 45 days. We will do our part to get you ready to close, typically within 30 days. But there's other things outside of our control, right? What happens if the appraisal comes in short? What happens if the title is not clean, right? And we can close, and I didn't mention this, I should have, but we can close a loan even with some open CO issues. Like if someone did a deck with no CO, we can close as is. If someone converted their garage to living space, we can close as is without a CO. If they converted their attic, things like that, as long as it's not health and safety related, right? We can close with open COs and open permits. We do what's called skinny title, right? That means we just don't look at those searches, right? So we can get those done. But if it's something significant, or if the buyer is not going to be, hey, I'm not okay. The buyer says, I'm not okay with that, then it may not close in the 45 days, right? Does that answer your question, Glenn? Yeah. Glenn?
Yeah.
Okay.
I'm sorry.
No, it's okay. So there's a lot of stuff going on. But, my goal, again, as a loan officer is really to educate not just the agents that I work with, but educates the clients, right? Because they don't know. They've never done this, or they've done it once. You know what I mean? They're not experienced. So all I can do is educate them on where things are and where I think they're going to go. But I let them make the decision because it's their call. The last thing I want to do is someone said, hey, you told me to not lock and now rates are, I don't want that. Nobody wants that, right? So it's the client's call, but I do educate them a significant amount. Any other questions?
Bill, you said the housing appreciation outpaces inflation by 2%.
Per year. Yes, sir. Yes, those are numbers. And I sent you the chart that showed the median price from 1972 to 2022. That's 50 years, right? And if you look at it, the actual price increased significantly, right? It went from 26,000 to 374,000. However, when you factor in inflation, which is an important thing to look at, right? Even after inflation, the real appreciation rate after inflation is 2% per year, which basically means every 2 years, the real value of your property after inflation is going up. So that's why it's a hedge against inflation, right? And if you look at, again, the cost of living and what a dollar is worth now compared to 20 to 50 years ago, it's the value of the dollar is much, much lower. What it costs today to buy something, I think, like I said, it's about $20 to 1 compared to where it was in 1972.
And then a 1% increase in a rate decreases a buyer's borrowing power by 13%.
That is correct. Yes, I
Yeah,
did the
that's a
numbers
really
up.
good talking point there.
It's
With
really
sellers.
vital. Yeah. It's really vital because, again, you guys know, and you guys probably seen this already, where prices are starting to soften, right? Have you guys seen this?
Yes, absolutely. I think so.
Without a doubt. And appraisers, here's the big thing, right? Appraisers are ahead of the curve on this because the organization that oversees appraisers, they kind of give them a fair warning. They're like, hey, rates are going up. That means there's going to be less demand. That means prices are going to soften. And appraisers already know this. They already see it, right? I've seen 1 or 2 appraisers come in below. Okay, we try and fight it at that point, but there's usually some renegotiation that goes on, right?
That's without the comp. Whatever comp is higher than that, you can't.
If there's a legitimate comp, but you know what's been happening is that people, and this is more so on the boroughs that I've seen, people are still bidding higher by $50,000-$60,000 above asking, right? Look, if the comps are there, the comps are there. But if you're just bidding way above and it's not, and the comps aren't there, then the comps aren't there, right? So it used to be, 4 or 5 months ago, appraisers were like, yeah, we can push it. That's not happening anymore. That's what we're seeing. So be careful how you price things. That's really the most important thing, right?
Phil, can you give a little bit more information on your rehab loans and your construction loans that are built on top of the mortgage?
So a renovation loan, whether it be a 203K or Fannie Mae Home Styles, is a great product. And the reason is because let's say a client likes a house, but it needs work. It's in bad condition, needs to be renovated, needs to be updated, needs to be freshened up. And the clients come in, but they don't have a lot of money, extra money after the closing to put the money and do cash with it. So what we do is we give them a loan, and we actually one of the few lenders that have a renovation department in-house. So we don't just farm it out to some company and say, hey, do this loan for us. We actually have a renovation department in-house that handles all the draws after the closing. And so the client can go in, they can buy the property as is, and then we talk to them and say, okay, how much money do you want to, how much renovation do you want to do? 50,000, 100,000. I've done loans. We did one out in the Hamptons where the buyer was putting in $300,000 worth of renovation, and we were able to do it. And here's the great thing about the reno loans. They're based on not the current value of the property, but the after value, and that makes a huge difference in the appraisal. So it's a great product. It's a great product, obviously for the right clientele. I don't know if that answers your question. And we do have all kinds of marketing material on renovation loans. If you have a client who's interested in doing one, we have a whole write-up on how it gets done. And, it's not as complicated as all that, but it does take some extra steps. Getting the contract involved. He's got to be licensed. He's got to be insured. There's other pieces of the puzzle. We got to get the construction estimate ahead of time.
Okay.
There's more pieces, but it's a great program. Great program. Do a lot of them.
They can do that even with like adding like a dormer, like fully dormers. They can do that, like adding more square footage to a house.
Absolutely.
So how does that impact, like if someone was pre-approved, let's say for 600,000 and they find a house and it needs work, like they still would then have to qualify for, like, if now they needed 600 plus like 50,000 for renovation, like
Right.
can they go to push to a higher DTI at that point, or is it the same lending criteria, if that makes sense? I don't know if I'm wording
It does. Usually, a good question. Usually it's the same lending criteria. So that means, like, if I've pre-approved a client for 600K, that means the entire loan has to be within that framework, right?
Mhm.
So we would then have to fit it in. And also, but remember, a lot of it depends on the property taxes, right? So if you find the house with lower property taxes,
You
then
can go
those
up.
numbers can go up, right? Exactly, because it's got to fit within the certain debt to income ratio.
Yeah.
You know what I mean? Sometimes we can squeeze a little bit more. I try not to, when I do a pre-approval, I try not to max it out. I get, because if the littlest thing goes wrong, or if interest rates go up, you're dead in the water. And
Yeah.
you're wasting time. We don't want that, right? So I try and leave, especially now, leave a little bit of extra room, and say, look, you can go a little bit higher. And again, then it comes down to what is the price of the house and what are the property taxes, that's going to, and how much down payment you're going to put down, right? Those are the three most important things. But yeah, you got to leave a little room. But it's a challenging time, to be very honest with you. And I've been through that, like I said, the crash. This is definitely a challenging time, only because rates are moving up. This is the fastest interest rates have ever gone up in this country's history in terms of speed, going from here to here. Inflation, and the government printing money like crazy. That was, No, some of it is post-pandemic. I get it because the government wanted to put money into the economy to stop it from crash. I get it, but I think they just went overboard, and everybody's getting, $800 checks and whatnot. I mean, that's just, I don't know. I don't know if that was necessary, but that's part of the reason why inflation has kicked up so much. And then supply chain issues from China, they shut down. So there's not as much stuff coming out, and people still want stuff, so that they drive the price higher. That drives inflation as well. So there's a few different things going on. So, but it's good for you guys as agents to know like some of the backstory, like why is inflation going up? So you can talk to your clients, right? Because you don't want your clients to know more than you, right? If a client comes to you, what's that?
Sometimes that happens.
I agree, but obviously that's not a good position for you as an agent to be in, right? You don't want your agents to say, hey, yeah, what about this, this, and this? And you're like, well, I'll get back to you. You want to have at least a talking point where you have an idea of what's going on. You can always say, look, that's a good question, I'll get back to you. But obviously you want to have some background and understanding, when someone says, hey, the Fed is raising rates. Well, that's not what's raising the rate, right? It's mortgage-backed securities. Like I said, they're correlated, but they don't go one-to-one, right? So it's good to have some of that background information. But then again, this is where you have me, hopefully. You say, just give my lender a call. I trust him. I know he knows what he's doing. He'll explain it to you. And I will explain it to them. I spend quite a bit of time with clients explaining how things go. I want my clients to feel comfortable, right? I don't want them to feel like they're being sold.
What's the highest level of DTI level that we can actually get a commitment letter on?
For an FHA, we can actually go to almost 47 on the front end ratio and 56 on the back end.
56 is all the other debt. A back end, all the other debt.
The overall debt, right?
Overall.
The front end is the housing ratio. The back end is the overall ratio, right? On a conventional loan, the front end typically stays under 50 and the back end, under 45, and the back end stays under 50 for a conventional loan. But I play with it. I work with it to see what can work best. Maybe we can squeeze a little more income out of here. Maybe we can put more down payment, and then I run it through the Fannie Mae underwriting engine. And once we get a DU approval, then we feel very confident that it's going to work.
And if you're borrowing money against your retirement, that doesn't count as DTI.
Correct. Yeah, you can usually borrow, and that changed about, 3-4 years ago. It used to be where you couldn't do that. But then 3-4 years ago, I forget, maybe 5 years ago, the government changed the guidelines and says, hey, if you borrow against, not withdraw, but if you borrow against your retirement account, don't count it against your DTI, and you don't have any penalties, any taxes, which is it's a great thing, right?
I forgot the type of loan that you can get that wouldn't go on your credit report.
Mortgage loan?
Some type of mortgage loan.
A private mortgage loan would not go on your credit report. Like if you have a seller who's given you a mortgage, who's taking back financing, that typically it's recorded, because if you're holding a mortgage of any kind, you want it recorded, because if it's not recorded, you don't have anything legal, right? So even if you're a private individual and you give a mortgage out, you still want to record it, but it doesn't show up on credit.
Maybe is it maybe in the commercial mortgage world that a commercial mortgage won't go on your credit?
If it's personally signed, then it does.
If I borrow money as an LLC, then that money doesn't go on my personal credit report.
Typically not, but if you had to personally guarantee the loan, then it would. As long as it's against your social security number. Now, most commercial loans are done with personal guarantees, unless the corporation is been in business a long time and can produce significant financials, right? Because think about it, most LLCs are empty shells, right? They're just used to hold the property, right? So lenders know this. So they're not going to lend to, Joe Schmo LLC, because Joe Schmo LLC is nothing. It's just an entity. It's an empty entity, right?
Okay.
Obviously, if you have a C Corp or even an S Corp that has a lot of good strong financials, then you could get a commercial loan against that. Yeah, absolutely. Yeah, without it affecting you personally. But most of the time, commercial loans do require personal guarantees.
So why do you think landlords with multiple properties in a portfolio are more likely to get a loan than sometimes they say it's only with a landlord history or like investment history?
I'm not sure I understand the question, Glenn.
Like if somebody who had a few properties and they ask for your history of if you were a seasoned investor,
Oh,
you're
I see.
sometimes eligible for a loan more than a typical first time investor
Newbie.
buyer would be.
Yeah, of course. Yeah, commercial lenders want to see experience, right? They want to know that you know what you're doing. They don't want to be. They don't want it that this is the first time at your first time at the rodeo. You know what I mean? They want to know that, hey, this guy owns 3 or 4 properties. He knows what he's doing. He knows the ins and out. He understands about collecting rent. He understands about property. He understands. If you're a newbie, you don't really get it, right? Especially when dealing with tenants, right? You may not get it. You're like, oh yeah, this guy's going to pay me, and until he does, right? The tenant's going to pay me until he doesn't.
So what do they look at, the Schedule E?
Yeah, if you have everything on your personal tax returns, they look at your Schedule E. Absolutely, how many properties you own. Absolutely, yeah. Any other questions, guys?
Just really quick,
Yes.
you had mentioned before about locking in the rates. It's 45 days, 60 days. So on average, if somebody locked in at 45 days and it expired, is it more expensive to extend the rate than it is to lock in at 60 or 90 days if we're not sure when something's going to close? Like what's sort of the difference?
That's a good question, Monica. It really depends on the deal. Most of the time, it's less expensive to lock in for a longer period of time than to extend it, most of the time. But it's kind of close. Let me put it that way. So ideally, we want as a lender, we don't make any extra money on extension fees. We don't. We don't take any of that. So we don't want that to happen, right? Because it causes headaches at the end, right? Now you're asking for money at the end. We don't want that, right? So we try and really gauge it, like how long is it going to take? So from our point of view, we want to get the loan approved, and we do within a couple of days, really. And then we work on the conditions. And me, again, what I try and do is get as much of the documentation upfront as possible, so that I'm not, not like the underwriter's not asking for 3,000 items, right? Getting most of what I need at the front end. The underwriter probably will ask for some documentation, of course. And then there's the title, and then there's the appraisal. So if all goes well, literally, we close the deal within 30 days.
Good question.
What is there like a certain amount? Like if somebody's asking and they really like price wise,
it's comparable. It's comparable, but I would say that the extension fee is probably a little bit more expensive, especially if rates are in an upward trend. All right, because the bank has locked in that interest rate for that period of time for that amount of money. So if rates are still going up, it becomes a little bit more expensive. Whereas if rates are flat or going down, we may even be able to extend it without a cost. Sometimes in the past we do a 7-day extension without a cost.
Okay.
If it's in a flat environment or a decreasing interest rate environment. But an increasing interest rate environment, it's costing us, so it's going to cost the client, unfortunately.
Thank you.
No, of course.
Think about it as like, if you're 90 days out, nobody can see what's going to happen in the future. If you're right there and you have to extend it, if they're going up, the lender knows what they have to hedge at that point, and it's going to come at a more dear cost. If they're flat or going down, like Phil said, it's, they know they're pretty safe.
Yes. Good way of explaining it. Yeah. So, any other questions? And one of the things that we do, I should have mentioned this, but is that we do a lot of, we try and do some co-branded marketing with the agents that we work with. So if you're doing open houses and things like that, we do co-branded flyers. Also, one of the things that we offer at no cost to the agent is we do co-branded door hangers. So if anybody does that, old school, knocking on doors or just putting door hangers out, it's a great tool, especially during this time of the year when it's summer and people are out, and it's a great way to meet people. You know, we think that everything is about the internet and that kind of thing. There's still a lot of people, especially sellers. Think about most sellers. Most sellers are still old school because they're probably older, right? So, you know, they're used to, you know, face to face. They're used to, you know, maybe mailings. They're used to, you know, physical door hangers, things of that nature. And it's a great way to meet people, especially on a Saturday. What do you got there, my friend?
That's
Glenn.
the door hanger you made me.
Yeah, man. There you
Oh,
go.
I saw those.
Yeah,
There you
door
go.
hangers.
There you go. No cost to you. So if you guys want to do that kind of marketing, I mean, I think it's a home run. Even if you don't say do door hangers and you go and you knock on doors, you just put it on somebody's door, just to have and hand out to people like a big business card. You know, they're not going to throw that one away probably, right? They're probably going to hold on to it. You know, you put it in, you know, if somebody says, hey, can I put this in your pizzeria? I mean, anything, right? So marketing is always about getting your name out there, right? Yes, Glenn.
No, I was gonna say, so I know you made door hangers for Sylvia, and somebody said that they picked Sylvia's door hanger out the garbage and called her.
There you go.
Wow.
Talk about
That's
a
pretty
plug.
sweet.
So when they do throw it out, it comes back.
Yes,
And it's about
like a
consistency. too.
boomerang.
Like, don't just do it once, because I always say they're throwing your face out once a month, once a week, however often. They'll throw your face out until they need it. That's the first time I've heard about someone fishing it out of the trash. So that's a pretty good plug right there. But they'll wait for it. They'll say, oh, that's that face that always comes. They sell real estate in this area. Not
It
gonna throw them
helps,
out
it
this time.
helps. If you have your door sign, your for sale signs in the neighborhood with your face on it, have to have your face on it. And now you go into the neighborhood, putting your door hangers in every neighborhood, they're gonna see your door hanger, and they're gonna drive out on the street, they're gonna see your face and again and again.
It all compounds, definitely.
Yeah, exactly,
You
exactly.
know what really works great if you're doing an open house. If you're doing an open house wherever it is, and you know the weekend before or a few days before the open house, you just walk around the neighborhood and knock on some doors. Hey, we're doing an open house down the block here. If you'd like to come here, you know, here's some information. I mean, it really works. I mean,
Sure.
you know, again, as long as you're professional about it, right? You know, you don't want to come off with a, you know, full beard and you know, you don't want to come out. Although, you know, this interesting thing is with COVID, people were wearing masks, right? And I think we can get away from it, I think. But if you go to a door with a mask on, I think it's
Yeah.
going to be, you know, it may not be the best look, if you know what I'm saying. But I don't know. That's certainly protocol for you guys. You guys would know better than I would. But I think being casual and knocking on doors is a great thing.
And the hotter the day or the colder the day, the better. Not for your own comfort, but because the seller will say, oh my God, this guy's out in 100 degrees, dressed nice. And you'll shed some pounds that way too. It's a good workout. All right, I want to be respectful of Phil's time, everybody's time. It's almost 7:30.
One more question.
Okay, yeah.
Okay, bro.
Bill, is
sorry,
there
yes, sir.
any kind of products for non-occupancy buyers? Like non-occupancy owners?
You mean like renters, like
No,
investors?
No,
Investors?
no, for if you want to buy a residential property and you need more income, but you want to put somebody else's name on it, but they're not gonna live at the house.
Yeah, that's a good question, Glenn. For a single family home, you can have a non-occupying co-borrower for a single family home,
Conventional?
conventional and FHA. So for a multifamily 2 to 4, then you can have a non-occupying co-borrower. You can have a bulk co-borrower that lives in the house, but for a single family, you can have a non-occupying. I'm doing a deal right now, or I should say, I approved a client who's buying here in Long Island, Melville. Her cosigner is in California. Doable, absolutely.
I don't mean to jump off. I gotta run for another call.
Okay.
Thanks,
course.
Phil.
I think
Thanks,
that's
everyone.
we're gonna end it here actually. So good timing, Monica. Phil Caporusso, everybody.
Appreciate your time, Phil.
Everybody can
Thanks,
see
guys.
the number
Phil.
and info. You know, if you can't see it in the chat for some reason, just let me know and I'll share it. And
We'll share the
yeah,
business
thanks so
stuff, too.
much. Definitely
Thanks for
use it
having
as a
us.
resource. It's
Thanks,
great.
and,
Thank you. Any questions, feel free to give me a call.
Phil, thank you very much.
You have a good
Thanks.
one. Thank you.
All right,
Have a great
everybody.
day, guys.
Thank
Take
you.
care.
Phil,
Bye.
we're gonna have a little get together one night. You should come out.
Yeah,
If you're buying, I'm coming.
That's a given. We appreciate it.
All right,
Thanks,
guys.
guys.
All
All
right,
right.
Phil.
Be well,
Take care,
everybody.
guys.
Take care.
Bye.
Take care.